All right, good evening, everyone. Good morning, good afternoon, depending on where you're joining us from. It's 2021, and we hope and wish and pray that this year will be much more better than the last. I'm assuming that practically everyone here is struggling one way or the other, because we made it clear that it's just going to be something simple. And we just want to help those who might be struggling with trading. As a precursor to our discussion today, I'd like to show you something. If you Google the world's top 10 hedge fund firms, you would find number one to be Bridgewater Associates. Some of you might know the name Ray Dalio, right? That's the number one hedge fund firm in the world. He founded this firm in 1975 in his 2-bedroom apartment in New York. So you could just compare yourself with this guy and ask yourself, are you in a 2-bedroom apartment or perhaps just a 1-bedroom apartment? Well, this guy started this stuff 1975, and he's been there since then. He's one of the richest men in the world presently. The fund has about 138 billion under management. Second person, Renaissance Technologies. Again, the owner is the 23rd wealthiest person in the world, right? But that's not why I came here. Bridgewater's associate, top 20. Bridgewater were 18.6% in drawdown. In November, where Tesla did well, Adobe did well, where stocks generally did well, Bridgewater, the world's foremost hedge fund, was down 18.6%, right? Can you guys hear me? Somebody is disturbing the screen here.
We need to stop, we need to restrict this annotation.
Okay, I'll do that. That was very rude. You could have just typed it in the chat box rather than right on the screen. Fortunately, I didn't get the name of the person. I would have kicked that person out straight up. Right, so Bridgewater lost 18.6%. I had to bring this up, and I'll be playing down on this sentiment after this webinar. I had to bring this up because we had a tough time in December last year trying to help the psychology of traders and make them understand that losses would come. Several persons were pointing at some gurus or some mentors somewhere who they claim could do 200%, 300% in 1 week and 2 weeks and the likes. And we showed several things. I just want us to know that Bridgewater, the foremost hedge fund, even though I understand that it's easier for small-time traders to triple their accounts because you can hide in the market. If you are Bridgewater, it's difficult to hide your entries from other big banks. It's difficult. When you enter a trade of 200, 300 lots, or as the case may be, I don't know what their lot size will look like. It's difficult to hide those kind of moves, and they'll be, subject to attacks, stop hunts, and all the likes, right? But I just want us to know that these guys would definitely have the best brains, right? Intelligent people who basically understand what market is. I tell you that some of us who call ourselves guru, if we work in this type of firm, Or if we have a friend working here who would claim that somebody who is working in a bank gave me a secret. Well, these guys were down 18.6%. And that should just ring a bell for those of us who try to trade without stop loss or try to behave like we know what the market is going to do exactly. The fact is that we don't know, right? I guess so many people are using Zoom for the first time. So many people can't hear me, but we can't stop. We just have to keep moving. All right. So I mentioned that I'll be discussing one risk. Sorry, I might need to mute everybody out too, since I'm hearing a voice in the background. Can you guys hear me now? Sorry, can you guys hear me now?
We can now.
Oh, okay. Sorry. I went off halfway. Well, Prof, where did you guys lose me?
Just after you said you need to mute everybody.
Oh, okay. Sorry. I guess I muted myself. My
Yeah.
second device. Sorry about that. All right. So I promised us we're going to discuss two simple strategies, and I also promised I was going to give us a risk-reward ratio that I personally used to pass the FTMO challenge on 2 occasions. I'm going to share it here, and hopefully you guys can try it out and see if it syncs with you. The methodology will work well with one of the strategies we'll start discussing today. I don't know if we'll conclude it today, but we'll start that discussion today. And let's see how it goes. So many of us are used to you do a 1:1 or 1:2, right? But I want to discuss a risk to reward ratio called the asymmetric risk to reward ratio. It comes in various forms, actually. It comes in various forms, but this particular one, and for those of us who don't know FTMO, I'll just give it a brief. It's a proprietary firm, and they accept certain small charges to test your competence in trading, and they pass you through a twin level check. The first one will be like a challenge where you get to make 10% per month, and the second one is a verification process where you get to do 5% within 60 days or thereabouts. You could actually conclude everything in a month if you are that good or lucky, as the case may be. And after then, you are funded, right? They give you an account to trade. Of course, it's still going to be a demo account, but they claim that they now copy your trades into a live account. So, and it starts from like $10,000 to $100,000. In the fostering class, we call it fostering class in SimplyPips, which is more or less like what some people call the mentorship class. We try to make people think like proprietary traders. No serious investor will allow you risk 20, 25, 30% of your account in a month simply because you want to triple an account. They won't do that, right? So the basic challenge with FTMO is passing the very first month, which is actually getting through the 10%, right? So, but this risk reward ratio has been helpful, and I'm hoping some of you could try it out and see how it works. So traditionally, when we do risk reward ratio, we do something like 1 is to anything greater than 1. In fact, if you've been trading, 1 is to anything less than 1. And when I say 1 is to, the very first number here stands is for your reward. So, and we call your risk R. We call it R. So if you do anything less than 1 is to 1, you are not going to be profitable long term. And this has been proven scientifically and any other way you want to think about it. It's been proven. If you trade and your stop loss is often 50 pips, but you are happy to take profits at 30 pips, 20 pips, and the likes, you eventually not make money, right? So your account curve could look something like this at first, but it will eventually come down because it means you are taking bigger losses than wins, and it will actually hurt your account. And this is what happens a lot to scalpers, right? They grow accounts aggressively, they flash the results, but after a long time, after a while, the account empties, right? Because you're taking more losses than you are taking winners. So there is this common slogan that many traders say that you don't go broke taking profits. Well, I beg to differ. You can go broke taking profits if you take profits the wrong way. If you take profits the wrong way, you would go broke. Now, so the asymmetric risk reward that I use uses a 1:3 risk reward ratio. 1:3 risk reward ratio. And you get to understand later on as we move on, either today or tomorrow, that to be able to do this, I would say seamlessly, but slightly easier than normal, you should be thinking of trading on a higher time frame, right? Your setup should be on a higher time frame. Your entry, of course, can now be on a lower time frame, 15, 20 minutes, 15 minutes, 30 minutes, 5 minutes. Now, so what this does is that if I take the very first trade, I tend to want to reach 1% of the account for every trade, just 1% of the account. But so if my R is 1%, it simply means my reward will be 3%. So if I'm risking 1%, it's because I have a potential of making 3%. And not just a potential, I will set the TP for 3%. It either hits my SL or hits my take profit. No trading of stop loss, no taking of partials using this strategy, right? So if I take a trade and I win, my account will be up 3%. Now my account is up 3%, and usually I risk 1% for every new trade. So what will I do? I'll add this 3% to the initial 1% that I was supposed to risk for the new trade. And now the next trade, I'll be risking 4%. I'll be risking 4%. So you'll be risking 4% to make 12, 1:3. If it's a winner, I'll make 12%, and I'm already 15% up, passing the FTMO challenge. The other thing will just be to pass the other challenge, which is the number of days you have to trade, which usually is like 10 days, right? So this is an asymmetric risk reward. There are various patterns. I will recompute this in another way. So let's say we take the very first trade and it's a loser, and that means I'll be down 1%, right? Let's say I take the second trade and it's also a loser again, I will be down 2%. If I take the third trade and it happens to be a winner, I will be up 1%. I hope you get that, right? I was risking 1, I was aiming for 1:3 here, I lost -1. Aiming for 1:3 at the second point, I lost -2. aiming for 1:3 here. I won +3, that gives me +1, right? Now the second trade, I'll be adding this +1 to the next one, and the second trade, I'll be risking 2%. I'll be risking 2%. If I win, I would have +7 straight. 2 wins straight, I return back to 1:3. If I have 2 consecutive wins, I return back to 1:3, right? So if I go back, the next trade will now be 1:3. If it happens to be a winner, then I'm up 10%. If it is a loser, then I'm down +6, right? It turns out that if you use this method, your curve, the growth will be, when you are losing, you come down a little, and when you win, it climbs up a little bit more steeper. Of course, risk-reward ratio alone is not what makes you a winner. You have to have a strategy that gives you an edge. So what you are hoping is that your edge plays out. You are looking for 2 consecutive wins, right? 1:3 each. And once you've had that, you go back and start again, risking only 1%. So you compound your winners in your 2 consecutive wins, and you go back and start afresh again. I believe I've been able to make myself clear on that, so we don't have to waste so much time. So if you've been finding it difficult growing an account, please, you can give this a try. Maybe not necessarily on your live account. I'm not a financial advisor, but I'm coming to like asymmetric risk-reward ratios even better. You could play around this on Excel and see. I'll do one more and we'll move on to the next thing. So let's say we have 3 losers. You lose 3 times. At the end, that will be -1, -2, and this will be -3. Right? This will be -3. If I win the 3rd time, I'm back to the beginning. Again, if I win the 2nd time, I'm up 3%. Right? Then I start again at 1:3. Right? That is the asymmetric risk-reward ratio. They are different. Some people do. One of my very good friend, very good trader I respect, does 0.5, then to 1, then to 2. So he starts with 0.5. If he wins, it goes to 1. If he wins, it goes to 2, and like that, and like that, and like that. Right? So, but that is that. I want you guys to just try it out. If you are very, very new to trading, everything I said here will look like French or Chinese. Then it just simply means you need to get to that. Let's move on to the next item here. So there are 2 broad ways to look at trading, and I'm going to a strategy now. 2 broad ways to look at trading. The first one is where you want to convince yourself that you know the reason why everything happens. You want to convince yourself that you know the reason why everything happened. You want to convince yourself that that stop loss that just happened was a stop hunt. You want to convince yourself that I know the market maker is going to make a move after a W, right? This is one method, right? And there are some set of people by their temperament, they love this method of trading, right? The only challenge with this method of trading, or one of the challenges with this method of trading, is that it is highly discretionary. So it leaves so many things to chance. You have to guess so many things. You have to assume so many things. And that is why trading patterns that go in this form gets a lot of people confused. And in this pattern, you see things like the traditional ICT trading systems, the traditional BTMM trading systems, because you want to say, okay, I know exactly what is going to happen, right? And I found out that people who are successful trading this pattern actually fall into the second category, right? They trade category one, but in the real sense, they're actually in category two. In category two are those people who don't really want to know what is happening, right? They just want to follow a particular pattern. So you see people trading ICT, but they narrow down to turtle soups and narrow down to Judah swings or raid on liquidities, and that is the only thing they trade. They don't bother themselves about quarterly shifts, COT, open interest, and the likes. They just face, a particular pattern, because when you open your mind up to too many things, then it becomes difficult to pull a trade. There'll always be a fair value gap ahead of price and beneath price. So where would price actually go to, right? So I would not be looking at this method of trading. Since we assume we're talking to newbies, we would be looking at the second method of trading that has fixed rules, right? Sometime this year, maybe by February, we would be launching a new pattern of trading that many of us might not have seen, and it will help you decide if you want to take a trade or not by just a single line on your chart. If price goes above that line, you buy. If price comes beneath it, you sell. And it's as simple as that. Very revolutionary method of trading. But for the beginning of the year, well, let's move on. So we'll be looking at this. Now, several people fall into this category. Some of them are people who like to use indicators. Some don't like using indicators. Some use price action and the likes. And what we've been teaching on YouTube, take out the indicators, falls into this category where we don't want to know what the news is saying. We don't want to know what is happening. We don't claim that we know that one liquidity is somewhere that will be taken, right? Because there could be several liquidities, fair value gaps in between, and so many things, and we get stuck halfway. We just want to trade a pattern, right? And today I'll be introducing us to trading order blocks on a higher time frame, right? Part of what we do in the fostering class, I'll be giving us, even though we won't divulge everything here, but we'll be giving us enough to take us up. We're looking at order blocks on the higher time frame. Now, if you want to trade order blocks in a higher time frame, it's just as good as saying you are trading supply and demand, right? So I want, so that it doesn't look like we cherry pick. We don't cherry pick. We don't cherry pick in SimplyPips, right? So I'm going to allow you guys to type in some pairs, and we might just look at the first two or the first three and use that as an example. So yes, somebody type in GU, and I'll be using GU. Right, so using GU, we have GU there, we have UCHEF. So those are the first two. Let's look at them and see if we can adopt those. So all right, so we have GU here. Okay, so what we want to do is we want to make trading slightly easier for us all, where we focus on the higher time frames alone. And this you can do at the end of every week if you are trading off the weekly time frame, or the end of New York session. Notice there's a difference. Prof, am I still audible? Am I still audible now? Oh, sorry. Yeah, my internet connection went off. Sorry about that. So I was talking about setup, and I said A setup is when have a trade setup every time. Price going because your setup has not occurred. You have to learn to sit on your hands. So we will be using the weekly and the daily as our setup for this strategy. It's something you guys know already for those of you that have been in SimplyPips. We just want to do it on the daily or the weekly time frame. And what this does is that it gives you more time on your hands to do other things and to actually play, work on your emotions. So we would be looking at the weekly time frame. The premise to this strategy is that price will most likely, right, if I'm to rank it, even though I don't have the data to support this claim now, 50% of the time reacts when it gets to an order block, especially if it's a higher time frame order block. It will react. Will the reaction be extensive? That is a different ballgame. But that it will react, there is every likelihood that price will react when it gets into an order block. And one of the things we tell the people in the fostering class is that they should write it over and over. I will not trade outside an order block. I will not trade outside an order block. What it does is that it increases your chances of winning. So let's look at GU from the weekly and see how we mark up some order blocks. So I'll start from here. You notice that this is a bearish candle, right? This is a bearish candle. For this strategy, I'll be giving us a variation within these 3 days. We will be looking at 5, in fact, 6 candlestick patterns that will also help us to trade. But for this situation, we will be looking at this, right? This is a bullish candle that was engulfed by this bearish candle, right? For this strategy, we will be seeing this engulfment of the bullish make a down move, and we will be anticipating a reaction from anywhere within this bullish candle. Traditionally, from the week, for which case we expecting fair value gap to be closed at the open of that bullish candle or at the top of that candle name. We like giving those fanciful names, right? So anywhere within this point, we would be looking for reasons to want to sell. And until price closes, key term, closes, until price closes above the body of this candle, or if you want to be conservative, you say the week, but let's use the body of these candles, we are bearish. We will be looking for only sells. And why would we be doing that? Because we saw this bearish engulfing candle. Notice how price traded back into this point and then fell off, right? Price traded back again into that point and then fell off. Price traded back again into that point and then fell. A bearish or bullish engulfing candle. When you're trading this strategy off the weekly or daily time frame, for now, so that will not bring complexities into it, we would not really bother about the trend. However, I must state here that if you are taking this trade in against the trend from a weekly time frame, you should expect that price will give you at least 2 ADR or more of that particular pair. From a daily time frame, it will give you 2/3 ADR of that particular pair. However, if you are going in line with the trend, then you could start looking for other places to get out. I don't want to, again, confuse us so much on the first day, we'll discuss this in detail. So here we have the bearish engulfing, price traded to it, drop, price traded to it, drop. Now, we would not deceive ourselves that would have caught the whole of this drop to the downside, right? We won't deceive ourselves. Fine, it's happening. We can see it here, but we might not have been able to catch it. I just want you to get that at the back of your mind. Now, here again, we have this bullish engulfing the whole of this bearish candle, right? So what that means is that we are looking for reasons to buy off this level. We'll be looking for reasons to buy off this level, right? So when price trades back into this zone here, we will be looking for reasons to buy. By tomorrow or thereabout, we'll talk about refinement, how you can refine this even further. But just know that once you get a bullish order block, you're looking for reasons to buy. So price trades in, you're only buying. Price trades in, you're only looking for buy signals. You're not looking for sell signals. You're not planning to sell in this place, right? So people who trade demand and supply used to be like a demand zone, right? You're only looking for buys in this zone. So what it does is that you wake up in the morning and you know exactly what you're looking out for. How you define your trades, maybe you could define your trade and say, okay, if I'm going to buy, I want price to take out yesterday's low, I want price to take out Asian low. Well, that is up to you, right? The method we'll be adopting in this 3-day training will basically be just LSB and nothing more, right? Just LSB. So price trading, you're buying, price trading, you're buying, and that's all you're looking at, right? Here again, I'm going to take this out. I want you to see this. Notice this this bearish candle here, bullish candle, I beg your pardon, price traded through it. This does is that first, remember the daily time frame. I don't want us to consider the trend for now. Just fix your mind on spotting the order blocks first, right? This is a bullish candle traded through by a bearish candle. When price is trading back into this zone, we are looking for sells. We are looking for sells, right? So when this price traded through, we would be looking for sales. So somebody asked a question today in the group that if I'm using 4 hours as my bias and I'm expecting price to maybe create a breaker, should I go to 1 hour and take my trade even when the breaker has not occurred? And the answer we gave is don't trust a candle until it closes. Wait for that candle in that time frame to close to confirm your setup, right? So let's not waste too much time here. So here, if you go down to lower time frame, you definitely would have seen an LSD perhaps to take this trade. So when price is trading back again into this bullish candle, we will be looking for reasons to sell. We might not get a reason. If we get a reason, we might have been stopped out, and that is a losing trade. And let's take it that way. We would lose trades, but we will win more if we follow the rules, right? So here again, I take these two out. I'll take these two out. I want you to just follow. Here we have the last bearish candle that was traded up, right? Last bearish candle traded. So this becomes the next order block, bullish order block, right? The bearish candle itself was traded through. When price trades back into this zone, I'll be looking for buys. It's just as simple as that. My bias for that day will be buy. Now, so when we get to refinements and other slight technicalities, we will now tell us how we take the buys. But just know that this is what we're looking at. I'll be looking for buys here. And here again, you can see that buy. You see the buy happening. If I move my red I've got sorry guys, is a network, right? So I'll be looking for buys. Let's drop down to daily so we can see how this plays out. Should I buy? Should I sell? And then you are buying, get to a sell, then price start buying, you jump out of your buy mass. Nothing like that, right? You know exactly what you want to do. You know exactly what to do when you wake up. And what we tell our guys, news at either 10 or 11, simply your charts and know what you want to expect the next day. You can actually sift through 10, 8, 12 pairs and select the ones that have clean setup. Clean setup. And when I mean clean setup, you can clearly see an order block and you can clearly see price coming into it. Right? You can clearly see an order block and you can clearly see price coming into it. So let's go down, down, down. Let's start from here and see how we can take this. So here we see this order block, right? Clearly, this is a clear setup, right? You had this massive sell down, price was trading back up. Notice that this is a daily time frame. And using this strategy, we wouldn't have sold for 1, 2, for like 3 days. We will not have a reason to sell because we wouldn't have had any setup here. We don't care if everybody is shouting in the Telegram group that GU has gone 500 pips. And I wrote it down in part of the things I wanted to tell us today. I forgot. I'm going to use this opportunity to state it now. If you are here and you're a newbie and you are not profitable yet, and you are in like 150 Telegram groups, please go and delete them. You need just 2 or 3. And those 2 or 3 should be discussing something similar. If you don't do that, you'll most likely end 2021 the same way you ended 2020, hopping from one strategy to the other, right? So somebody in one group will say, GU is buying. And the guy that is saying GU is buying, you don't know him. This guy started trading last week. But you see, you wouldn't know. He just shouts GU is buying, and some people will not even go to check the chart. They will just open their MT4, look for an arbitrary lot size and click buy. Boom. Guys, that is not the way to do this stuff, right? You need to take your own destiny into your hands and know exactly why you're taking your trade so that you can know exactly when to get out. This is our bearish order block. Price, we would not be in a trade on this day, maybe. First, we will not be in a trade on this day. Second day. Third day, we wouldn't. Price traded into this. Depending on when price traded into this day, we might have gotten a sell. But I'm not looking at entry yet. I'm just discussing the concept today. If we look at that drop from this level to this level, is 142 pips. And I can tell you for free, most people who find the light in coming to Telegram and WhatsApp to tell you that I just smashed my trade, check, price just moved 15 pips. 15 pips. 15, right? And they will take time and go to 1 minute or 5 minutes time frame so that the drop will be looking very massive, right? Let's be wiser this year, guys. So price trades into this level, be looking for reasons to sell. We might not have gotten a reason to sell, but this was a drop, and here it dropped again. You need to know that if you're trading off the daily time frame, it simply means it take a longer time for your setup to appear. And you also have the tendency to make more. Remember I said, if you're trading against the trend, you will, on a daily time frame, there's tendency you could make 2 ADR, 3 ADR, 1 full ADR. If you are going against the trend, you could make 2 over 3 ADR. For those of you who don't know, ADR is average daily range, right? So price traded into this order block, and that is the sell. Now, traditionally, we would have been looking at this level here because of this bearish candle as another reason to either get out of our trade or look for a buy. Remember I said with this strategy, we can trade either way. So long we're doing this on a higher time frame. You could refine and tell yourself, I will only trade in line with the trend, because in that case, you have more to win than lose, right? And your winners might be more. But on the face of it, when price approaches this region, we will be looking for an entry to go long. We'll be looking for an entry to go long. It doesn't mean we'll be going long directly. If I'm to look at the low, and that could be like 97 pips if there was an entry. I'm not looking at entry today, we'll look at it to be 1, right? So we'll be looking for a buy here, and we might get one or we might have a losing trade. Well, price traded up, and it wasn't really clear here. But notice that we have a new bearish order block here using this candlestick. This one that looks like a doji, right? That is a new one. So when price approaches this region, whenever it does, we will be looking for reasons to sell. It's that simple. It's just that simple. On this particular candle, price approached that level and dropped 166 pips. 2 days later, it approached the same level and dropped 160 pips. As simple as that, right? So if you are new, please just follow it the way I'm saying it. You could do some modifications. I'm not saying this strategy is perfect. I'm just saying you could sit down and decide what you want to do when you see price moving, right? Now, this bearish candle here was traded through when price pushed upwards. That would have made this bearish candle your bullish order block. This bearish candle becomes your bullish order block. For those of you who have been following us for a while, you would have discovered, okay, we've gotten a daily breaker by now and blah, blah, blah. But let's leave that for now so we won't confuse the new guys, right? If you are the guys who still find it difficult and are still arguing whether the weak close beneath or the weak close above, price does not know that there is weak. It is you and I that is counting it as weak. As far as price is concerned, price is continuous, is fluid. It's what you see as a weak in a time frame can be a full-bodied candle in another time frame, right? So let's leave some of those academic discussions and just look at how price is being delivered. That's what matters. How is price being delivered? So here is the bearish candle, and price traded through it. So when, let's say this was a Monday, or rather on this day, this was a Monday, price traded, and this hypothetical, I don't know the date, but you, at the end of New York, you woke up or you checked your chart and you noticed that price traded above this level. You're basically going to put GU on your watch list and you will be anticipating a sell. That doesn't mean you should sell. You are anticipating a sell for a buy, right? So it took 2 full days for the sell to occur, and it even pushed further the 3rd day. Then we'll be looking for buys. Like it or not, price traded into this order block and bought for 202 pips. Again, we'll be discussing entry tomorrow. So we'll be discussing entry tomorrow. For now, just understand the concept, right? Some of these trades, I'm saying price move 100 pips. We might not even get an entry at all. By the time we get to entry, we might have to let it go because there wouldn't be an entry. But just see that you are just using the shapes and the color of the candlesticks to determine when to take a trade. We've not added one indicator here now. No single indicator yet, right? Just price. The bearish candle, price traded into it and buying. Now, notice something. We bought from here. Well, where did price reject from? Oh, there was a bullish candle and price traded through it. You see that? So with this strategy, you can safely trade consolidation from the daily time frame and consolidation from the weekly time frame. And when there's a breakout, well, there's a breakout, then we'll move on. So price traded, price sold, and gave you a bearish. So when you start buying from here, you should be anticipating a reaction from this order block. You should anticipate that reaction. You should. There were sellers sitting right here. You should anticipate it, right? So two things. If you're using asymmetric risk reward ratio, you might or might not have gotten out, but again, here you have a reason to go down. I'll give us an example with Euro NZD, right? So I took a Euro NZD trade today using just that, right? And the TP1 is out, but I decided to leave the second trade running so you guys can see practically how we do this. Now, this trade was taken from this order block, right? Order block for a buy. Today is the first trading day, so I got in a bit late. I didn't want to take any trade over the holidays, right? You understand what I mean? Else, I don't want to go into entry yet, but else our entry would have been here when we had the LSB. But we'll come back to that tomorrow, right? But let's go back to daily so you see what I'm saying here. Okay, so when price, look at this week, price traded straight into this order block, right? Traded straight into it. And can you guys see the reaction? If we go down to 15 minutes, you see the reaction. Price traded straight into that order block and see the reaction, right? So what if you have a scalper's mindset? If you have a scalper's mindset, well, I just give you a simple way of making 74 pips, right? From my entry to this level was 115 pips, and we didn't come to Telegram to shout, right? Because we don't need to. At a point in time in your career, you get tired of shouting on Telegram. You get tired, right? So 100 and something pips, 1/3, 1/4, 1/5 are done if you know when we get to refinement and how to take our entry. But one thing I just want us to see here is that price traded into that block and reacted. So if I considered what I'm teaching now, I would have been thinking of exiting my trade at that point, and it would have just gone there straight to the T. Of course, you wouldn't place it exactly there. You have to give room for spread. And you take out your trades, 100 and something pips times 2, and you're out quietly without. I don't know Fibonacci. I don't know what other things again. Blood in the water, shark in the fin. I don't see, you know, all those other things now, all those Jack and Chan and Jugunu things. You don't need to know when you understand. If you have watched Trading in the Zone, if you have watched The Mindset of a Professional by Mark Douglas that we posted, and we asked all to check to watch during the holidays, we do trying of convincing We can actually, and they are good. I'm not saying it is bad. In fact, they are good. But please, you can also, you later on discover that you can be profitable with just one moving average on your chart if you know how to trade it. And like I said, by February, March, we'll be rolling out a very new way of trading that will have just a line on our chart. And when price goes above that line, we are buying. If it goes beneath it, we are selling. And it's as simple as that. No big story, no big range, right? So somebody mentioned USD Chef. Okay, let's go back to GU. And we need to round up now. We have 9 minutes more. So notice, let's magnify this again. Notice you would have sold from here. And when price comes back into this region again, you are looking for sell. You continue to look for an LSB reason to sell or a takeout of liquidity that is a high. We'll get to that later on, either Asian high or equal high or whatever. You'll be looking for that reason to sell from this point until price breaks this level. When price violates this order block, then you are no longer a seller. You are now a buyer. But when would you buy? Well, let's take out these things again. You are looking at buying. Now, notice we've been following GU only. You could do this on all the pairs, and you could have been trading something virtually every day. Notice, can you notice that? Notice this, price traded through. You're waiting for price to come in. Price came in here, you might or might not have gotten a reason to buy. Or let's say you got a reason to buy. How many pips was that? 79 pips. You might or might not have gotten a reason to buy, but price drove in. We might or might not have gotten a reason to go for this 121 pips it went for. We might not have gotten a reason. We'll wait until tomorrow to do that. You see, but in all of this region here, we would be technically be looking for reasons to buy. And I can tell you the truth, whether you use Fibonacci, you still do not know exactly where it's going to sell from or buy from. And that is why you have 50, 61.8 sweet. If you use ICT Fibonacci, there's what they call sweet spot. Sweet spot is about 3 fib levels mixed together to call it sweet spot. So when you hear something, when you hear a term like sweet spot, it's just a sweet way of saying, I don't know exactly where I'm going to turn, where this price is going to turn from, but between A and Z, it will happen. Right? That is just a sweet way of saying, I don't know specifically where it's going to happen, but between A and Z, I'm expecting it to happen. So let's not overcomplicate things, right? And that's exactly what's happening here. So we'll be in a buy. And it's as simple as that. This sell, this massive sell that happened here, happened from this, but we would not have considered this a block. It was too wide. But let's move on. Here we have the bearish candle. Price traded back into the bearish candle, and this is sweeter now because you have a break in structure. And again, I don't want to discuss break in structure because it will begin to confuse some people. When it's price, how the price break the structure. Let's assume you don't know break in structure. You only know 2 candle type pattern, bearish and bullish order block, and that's all you know. And that's what you want to trade. So price traded above, you're taking it to the wick or to the body, right? If you take it to the wick, where you had a reason to buy. If you're taking it to the body, there is no reason to buy. And when there's no reason to buy, you don't buy. It's as simple as that, right? Now price came into this region. Here we have a bearish candle. Price traded above it. So it's for you to buy. You're looking for price to trade back into it for you to buy. Would you get an entry? Would you not have gotten an entry? Wouldn't know until tomorrow. But here you have that buy. Then you go back to the next one. Here it is. You're waiting for price again to trade back into it. Price traded. Would you have gotten a reason to buy or not? Wouldn't know until tomorrow when we start looking at it. But I just want you to see the concept. Here was a buy. Here's a trade back. Here's a buy. Right? So guys, we can do this over and over. And even the last part of last year, where price was whipsawing up and down, we could have entered the trade. This is the last bearish candle, right? I'm rounding up right now. This is the last bearish candle before this push-up. Believe it or not, this candle here This red candle here is a bullish candle. This red candle here, let me mark it clearly so you can see. This candle is a bullish candle, guys. It's a bullish candle. Don't mind the way the broker painted it. Watch this. This is a bearish candle, right? It traded and came down. The same price where that candle ended, the bullish one came and traded up, right? Look at this bullish candle. It traded up. The same spot where it ended, the bearish candle came and pushed down. Now let's come back to this. This bearish candle traded up to this point. So where did price, how come, there's a gap there, right? There's a gap at that point there. So this is actually a bullish candle. If you go to Oanda on TradingView, this candle will be bullish, right? Or at least there wouldn't be any gap. So I'm marking this point as my order block, right? If price trades back into it, you're buying, right? Exactly, you are buying and nothing more. And once you're done with that, you move to the next one, which happens to be this. This
couple of minutes ago, or like a couple of hours ago. So just pardon us for tonight. Just hope we've been able to flow so far. I think Bishop is back.
Yeah, Prof. I think we've done enough for today. It's 2 minutes to the top of the hour. We want you to job is 60 minutes. I believe we've been able to share value. The idea is this: it doesn't have to be complex for you to be profitable with it. It doesn't have to be complex. You don't need to draw. You don't need to build a shopping complex on your chart to be able to get rent, right? You don't need it. If you remember, I would say there are two types of traders: those that want to know why everything is happening. So why did price happen? Okay, it was because there was what do they call those harmonic patterns? What, Prof? Remember, what are the names of those harmonic patterns?
Exactly.
Butterfly.
Butterfly.
So because there was a butterfly, there was a bat, and there was an antelope. Yes, it's possible. If it works for you, use it. But please, if you are new here, you've tried butterfly, instead of pips coming to your account, it was flying away. Then stop using animals. Just use order block. Just somebody say goat. Just use order blocks, guys. So tomorrow we'll refine it better and now see how we will enter from the lower time frame. Remember, I said it's not all of the order blocks that will give us an entry. Some of them, the stop loss will be too wide, we'll have to let it go. But we would be profitable with trade order blocks alone, this time from a higher time frame. Remember, the higher time frame we're talking about here is daily and weekly. H4 can get things mixed up, right? So thank you guys for coming. By tomorrow we'll be discussing more and hoping to see some of you join our fostering program where we can push you up more. Go try the asymmetric risk reward ratio. I'll mention it again briefly at the first 5 minutes of tomorrow's session. Have a wonderful night, Prof. Thanks for coming online.
Definitely. For those of us that are interested in the asymmetrical ratio, I think tomorrow, if I don't do it early, just remind me. I'll be doing an Excel file that will enable you to just play around with those things.
Oh, great. For those of you who don't know, Prof is a computer guru. Don't worry. Very soon we'll replace what's his name? What's the name of this Apple man?
Steve Jobs.
Steve Jobs. All right. Thanks, everyone. Let's have a wonderful night rest and God bless you all. Somebody's asking, what's the Caribbean time for this? I don't know. It's 11 p.m. here our time. I don't know what time it is in the Caribbeans. All right. Good night, everyone. Let's continue our discussion on Telegram.